Good afternoon, everybody. This is Chuck Williams with Finspire, and I'd like to thank you for attending our webinar today on incorporating the U.S. government stimulus bill into your company's financial plans. This is the second in our series of webinars to inform and educate companies, individuals, and institutions on the rapidly changing economic and legislative environment, as well as provide insight and strategies to help navigate through these challenging times. Our first webinar was on the impact of COVID-19 on company retirement plans, including new participant loan distribution options, rules regarding amending company contributions, and other considerations for retirement plan sponsors. Finspire is an institutional retirement plan and wealth management consulting firm. I'm the co-founder, a co-founder of Finspire, and our senior corporate retirement plan advisor. And I've been advising on clients effectively managing company retirement plans for past 20 plus years, and I've been an adjunct professor at Northwestern University for the past 15 years teaching courses on this subject. Joining me today are Abram Claude, Vice President of the Learning Center at Columbia Threadneedle, John Spory, Equity Partner and Senior Commercial Banker at American Commercial Bank and Trust, and Jason Brooks, Vice President of Wealth Management at, who's also a Certified Financial Planner and CPA at Finspire. We've got a lot of great information to go through today. We anticipate the presentation to last approximately 45 minutes. However, given the amount of content, we may go a little bit longer. You're welcome to receive a copy of the materials by reaching out to us after the discussion, and we'd be happy to email that out to you. Everyone will be on mute, but please feel free to ask questions in the the Q&A tab, and we'll attempt to answer those throughout the discussion. If we don't get to a question during discussion, we'll answer it via email afterwards. So to start out with, we're going to give a poll to all those online, and just a brief question. All the panelists on our presentation have had many discussions with companies over the last several weeks in response to the impact of COVID-19 on their businesses. With that in mind, please answer the following questions. All poll answers are anonymous. We'll share a summary of the results. Thought this might be good information for you. So the questions are, which of the following most accurately describes your company's response thus far to the impact of COVID-19? You had major financial and logistical changes that you've already implemented. Maybe minor financial changes, but some major logistical changes. Perhaps some major financial changes, but minor logistical. Or minor financial logistical changes or really haven't had much changes at your company. So if you just take a minute, we'll give a few more seconds to answer those, and we'll give the responses. Just give another couple of seconds before we end the polling. Got a couple more answers coming in here. Okay, and so we'll end the polling and see the results here. And it's kind of interesting information. As you can see, the results here, spread across all four of those, almost equal. That is pretty interesting. So from people making major financial logistical changes to minor, nobody put no change, which is also interesting. So everybody, this is having an impact on everybody. Again, whether it's logistical, company, financial, or some combination of them. That is kind of interesting that it is, you see some of both of those. So we'll close that out, move on to give a bit of an update on what we're going to cover today. We're going to focus on four main areas. One, macroeconomic outlook. I'll give a brief overview of that. The government response, managing corporate cash flow, and then tax considerations and opportunities. A lot will focus on this, the government response. So I already mentioned that our esteemed panelists have joined us for today's discussion, and it'll be each covering various topics and available to answer questions throughout the presentation. So I'll provide a brief economic update. Abram Claude's expertise is on the details of the CARES Act and stimulus packages. So he'll be providing details on really the primary benefits for individuals and small businesses. John Spory's 25-year experience as a commercial banker will be apparent as he discusses the Paycheck protection program as well as some great insight on how you should be working with your commercial bank in these times, and give us a perspective from a commercial bank, what they're seeing. And Jason Brooks, really multidisciplined wealth managers, both a certified financial planner and a certified public accountant. And this, lead our discussion on the new tax benefits available in the stimulus packages and strategies to incorporate them into your personal and business financial plans. So to get started, let's give a quick recap on how we got here. So, well, it seems like a long time ago. It's important to go back just 4 or 5 weeks to recall pre-COVID world, as it provides some insight into what's happening now and where we're going. If you look here on the left side, before the COVID-19, if we start that sometime middle of February or March, depending on when you would kind of start that, how the impact on the economy. Before that, we had the longest economic expansion in U.S. history, steady GDP growth, strong labor market, relative cooperation between oil suppliers, single-digit earnings growth expected, strong asset returns, modest volatility in stock and bond markets, and yet accommodative central banks, with room to cut rates. So a pretty good economy, kind of going along pretty steady. And then since that, bull market turned into a bear market in record speed. So a few weeks ago, the first time in history, we had a bull market and a bear market happen in a 3-week period of time. That means it went down 20% and up 20%. So just incredible type of volatility. Social distancing recession, and this is an important thing. It's very different than 2007, 2008, which was a financial crisis. This is a social distancing recession, meaning government imposed rules, and just rules that we did as a society led to this really kind of financial kind of crisis. And then the oil dispute between Saudi Arabia and Russia, which didn't get a lot of press, but we talk about this as being the second black swan. First one being the COVID-19, something totally out of left field, unexpected. This would be the second one. This issue with Saudi Arabia and Russia triggering excess supply while demand faded. So you see oil down from $50 a barrel down to, it was in the high teens. And now we've seen some recovery. And then extraordinary market volatility. And then 2 emergency 50-point Fed rate cuts and unlimited liquidity backstop. So you had a massive kind of punch to the gut, frankly, that came in, and then a very rapid response coming after it. So obviously extraordinary times that we're in. So if we kind of look forward, and what we're looking at for signs that the economy is going to begin to recover. One is the outbreak mitigation, that you see some positive signs there, and we've seen some just in the last week, where they talk about this flattening of the curve in COVID cases. We do not think by any means out of the woods, and we expect this is going to be a continual battle, but there's some positive signs there. Some stability in the oil prices, and we've seen that. They've gone up from the high teens to down to the mid-20s, and some stability there, and some agreements on OPEC. The end of last week, it has added some stability on top of that. The plan for fiscal relief, so this is where the government's stepping in with the stimulus packages, have been significant. You might have heard just in the last 24 hours, more discussion about additional stimulus coming in. The rapid bear market may yield some opportunities. So just a second talking about the stock market relative to, most people focus more on the economy and the stimulus package. But if you look historically at recessions, often the stock market leads before the economy recovers. So you go back 2007, 2008, the market typically leads out of it. So before the economy gets better, often the market does. And the market certainly has rallied recently. Don't necessarily think this means we're out of the woods by any means, but just something to be aware of. And then the anticipation that it's going to be a staged recovery versus just a dramatic, obvious to everybody that there's a recovery, that it's going to take time for us to come out of this. So on the right side, some of the resources we have at Finspire, encourage everybody to go onto the website. We've had a lot of news and insights. Our Chief Investment Officer, Chris Karam, who's on the line with us also, provided about a 12-minute economic video. Encourage everybody to look at that. We're providing additional materials for corporations as well as individuals. So you can learn some more about our services. We have a risk score. It's great for individuals. You can go on, just a good time to take a look at your own risk score from a wealth management perspective. And if you want to engage by contacting a professional. So on the US government response, So what's been done so far to support the economies? Again, quite a bit. We've got three areas here: monetary, fiscal, and credit guarantees. So monetary is primarily the Fed decreasing interest rates dramatically, making it cost of borrowing significantly less. Fiscal being the stimulus packages, and then credit, infusing liquidity just to keep the financial systems going. So it has been significant, rapid response by the U.S. government as well as international governments to this response. And as I mentioned before, in like 2017, it's really not a financial crisis that led, it's more of a health crisis that's causing this, the financial crisis. So a quick summary on the three stimulus packages that came out. So March 6th, the first one, the Coronavirus and Preparedness Response and Supplemental Appropriations Act. This put funding in for vaccine developments, medical supplies. So you can see a lot of this was going right towards combating COVID. And about 8.3 billion was in that package. The second one comes out, it was 100 billion for the Family First Coronavirus Response Act. And this will focus a lot on employees, so paid leave, DOL administer emergency paid sick days, grants, emergency grants for loans to states for unemployment insurance, and so on. And then the big one, this last one, March 27th, which is the CARES Act. And you see this 2.2 trillion. And this is direct payments, so checks being sent out to individuals and families, which they're starting to see now. Unemployment benefits increased, hospital medical supply investments, loans, and then state and local funds. And then next question again, is there going to be a phase 4? It's looking like that's a pretty good possibility. But those are things that we're kind of keeping track of. So now talking about individual and family benefits, we're going to focus on those last stimulus packages. What are the main provisions of each one of these and how do they impact small business owners as well as individuals? So with that, Abram Claude from Columbia Threadneedle mentioned he's going to help provide an overview on the key aspects of these programs over the next couple slides. With this first one focusing on individual and family benefits. So the three main being extended paid leave, unemployment insurance, and student loans. So I'll turn over to Abram to cover this in the next slide. Abram?
All right, thank you, Chuck. So if you think about what we're going to talk about here, these are doing things on the part of the federal government that were out of the ordinary. And the idea was to help individuals and families have some cover during this tough period. Tough period where, as Chuck said, some of what was happening was due to not financial emergencies or other things, but due to government policy and quarantines. So one of the concerns is often it's with employers of 500 or less employees don't always have as robust set of programs as larger employers do. So what happened, there was a piece of legislation in that group of bills that Chuck was talking about that said if you're a 500 or less employer, you're going to have to provide a certain amount of paid leave, whether that's sick leave or whether that's family medical leave. In other words, I have to take a leave because of something that's going on with my family, not because of what's going on with me. And this is a requirement, and you need to do it. And you can see here the different rates of pay, a regular rate, what happens if you need to care for somebody, you're at a 2/3 rate, and then what happens if we need additional weeks. So this, again, focused with certain public and private employers with 500 or less. And so if the government's going to mandate something, then the issue becomes how is it get paid for? In other words, you can't mandate it and necessarily say, well, you have to pay for it. So what the government's doing in this case is saying, we're going to offset this with a refundable credit. And the employer can take this refundable credit because this program is started at the beginning of April, and you can start to take this refundable credit in one of two ways. Either when you file your Form 941, you can ask for a rebate against federal income taxes withheld and the employee portion of Social Security and Medicare, or you could withhold those and not deposit it, and then account for that when you file Form 941. So there is federal effort to help employers as they deal with that. Second thing is expansion of unemployment insurance, and it was expansion in two ways. One, we're showing here at the top, the $600 additional per week payment. I'm calling that a top-up. So when we think of unemployment insurance, when your employer, you as an employer, are paying into the state unemployment insurance system to have funds available when a situation like this happens. But what the federal government passed through legislation is an additional $600 per week for a 4-month period to what you would normally receive from your state unemployment insurance. And generally, most states sort of run that. They look at the average compensation in the state and will cover at least 50% of that in an unemployment insurance. On top of that, the federal government is extending the time period where unemployment insurance is available. Again, 26 weeks is what you would see in the state-administered portion of the program. Federal government stepped in and fund an additional 13 weeks, so up to 39 weeks in total from that. And this is in place through this year, through December 31st of 2020. One other way that's helping is helping with student loans. First, the federal government, if they are federal guaranteed loans, those are suspended. Those payments, both interest and principal, are suspended for 6 months out to the end of September. And on top of that, if an employer offers education reimbursement, which many employers do, an employer can offer that up to $5,250 as a tax-free reimbursement for education expenses to an employer. What the CARES Act did was extend what it could be used for to include paying off student loans, either directly to the loan carrier or to the employee. So it didn't increase the amount. It didn't increase. It's still capped at $5,250 is the maximum amount that can be done in this way, but it extended what it can be used for to include paying student loans. So those are a couple of ways helping individuals and families. All right. This is, when we look at this part here, how do we pay for the extended leave? And this is where we talked about you can get this through fully refundable tax credits as an employer. So you have to offer this to your employee, but the way that you can be reimbursed is these refundable tax credits. So you either retain the amount of all the federal employment taxes that supports the qualified leave expenses, and if that isn't sufficient, you can file a request with the Internal Revenue Service for advance payment. All right, a couple of other things to help, because we know that in tough times for businesses, it's so crucial to be able to hoard cash for essential needs. So there's a program called the Payroll Tax Delay. The way this works is that employers that have W-2 employees, and this can also apply for the self-employed, they can delay remitting the employer portion of Social Security. So when we think of Social Security, there's two sides of it. There's what's taken from the employee's paycheck, and there's what the employer contributes, each contributing 6.2% of the employee's compensation. So in this case, instead of having to make the deposit for the Social Security, you have to still do this for Medicare. You've got to do everything for Medicare. So we're talking about Social Security. But instead of doing the deposit at the scheduled time, you can delay that and have it remitted in two 50% annual payments way down the road. So the first deposit would be made December 31st of 2021 of whatever you didn't deposit over this time period, and the second would be December 31st of 2022. So it's a way of hoarding cash. Eventually, it's going to have to be deposited. And the other point to note, we're going to hear more about the Paycheck Protection Program. It can't be used with the Paycheck Protection Program if you're getting a forgiveness situation with that loan. So it is something where employers need to think, which is the better option for me, and do a little bit of math on that. For folks that are in really difficult straits, it's called the Employee Retention Tax Credit. It's equal to 50% of the first $10,000 in eligible wages paid to an employee, starting from the middle of March through the end of the year. It would end if 80% of prior revenue is recovered. But the idea here is that you're able to use this if you've had a either partial or full suspension of operations by government order because of the COVID-19 situation, or if you've experienced a greater than 50% drop in gross receipts for, let's say, Q1 of 2020 versus Q1 of 2019, or Q2 of 2020 versus Q2 of 2019. Now, this is really aimed, the most advantage of this is aimed at an employer with 100 or less full-time employees. So you could apply that refundable tax credit against 100%, against those employees in full. And if it's over 100 full-time employees, then the wages are more related to a situation where the employee is not working, let's say on family medical leave or extended leave. So most favorable for those under 100. And again, this can't be used with forgiveness under the CARES Act. So one has to think through which is better. But those are a couple of other ways that employers can hoard cash to use for other purposes. So Chuck, I'll stop there.
Great, thank you very much, Claude. And just kind of a quick summary and follow up. So on that, the first one that on this page, the tax credit. So we look at who's paying for that. The employer's paying for that, and then they're going to be offset with a credit.
That's right.
From the government, from future taxes that they're going to, that they can withhold future tax payments.
That's right.
Right. Okay. So
that's correct.
Yep. And then the tax delay and the employee retention credit. Interesting thing with both of those is, as you mentioned, you can't use that with the Paycheck Protection Program. So employers just got to feel, which ones do they qualify for, and just put those side by side. It's in most the Paycheck Protection Programs for those companies with less than 500 employees. So not everybody qualifies for that. But then, it's just a side by side. Which one's going to give you the better benefit?
Yeah, I think it's got to get the calculator out and the spreadsheet out and compare what you would do and which one would bring you the most benefit. I do think the important thing to remember with the payroll tax delay is it is a delay in that situation. So it is something that you will have to make up, but it's pretty far down the road when you have to do that.
Great. Very good. Thank you very much. So now to go through the Paycheck Protection Program, and this is what's getting the most discussions, a lot of press on this as well. For that, I'll ask John Spory from American Commercial Bank to mention 25-year plus veteran in commercial banking and very familiar with this as well as other loan programs. Just to go over this, and this is that forgivable loan payment program to provide loans can be potentially forgiven small businesses to pay up to 8 weeks of payroll costs. So John, I'll turn it over to you to give us some more detail on this program.
Great, thanks very much, Chuck. So as Chuck has outlined on the screen there's 3 topics that I'll go over briefly. First of all, the terms of the Paycheck Protection Program are very favorable. You can get a loan amount up to 2.5 times your average monthly payroll, And most of the banks have a tool spreadsheet that their clients can use to calculate and come up with that average monthly payroll. I know that the payroll companies have been very proactive in supplying their clients with the needed information to come up with that average monthly payroll. And then that gets multiplied by 2.5 times, and that comes up with the loan amount. It is capped, as the slide shows, at $100,000 for each employee. And another benefit, there's no collateral, no personal guarantees. It is a 24-month loan, and payments are deferred for the first 6 months of that term. The other key feature is within that first 6 months, the client and the bank will work in tandem with asking for forgiveness of the loan amount. Now, there will be a process to that. I'll get to that in a minute. But you want to get that forgiveness taken care of, preferably in the first 6 months. Why? Because after 6 months, if the loan has not been forgiven, whatever residual balance of the loan is remaining goes on a repayment program for the 18 months remaining on the loan. So it'll be a principal and interest payback on that portion. So that's basically the loan terms. They're very favorable to the client, and it is a great program. The second key area is potential loan forgiveness. We use the word potential because there is and will be a process associated with getting the loan forgiven. And the government is just recently, actually today, came out with some preliminary guidelines on what that forgiveness calculation will look like. But basically, it's going to consider both the payroll dollars paid and the number of full-time equivalents during that period of time from when you applied. In other words, they don't want the payroll to be the same in 8 weeks as it was, but your full-time equivalents are down to 2 people from, say, 10 people. They don't want the employer, the entrepreneur, laying off a bunch of people and giving themselves a big raise. So they're going to look at full-time equivalents and both dollars of payroll paid. So that's key. Right now, I'm positive that the guidelines that they've currently issued will be tweaked and modified, similar to what happened with the initial application process. There were at least 4 different revisions to the application. It's very fluid, never been done before, and so, you can expect changes. This is a historic event in this country's economy. I mean, think about it. Trying to spend $350 billion in less than 25 days. That's a major accomplishment. Our Congress did a great job, Republicans and Democrats, in rolling out this program to help entrepreneurs and their businesses. They had to do that. They know they had to do that because that's who employs the people in this country. So the loan forgiveness will be a fluid process. I'm anticipating it is going to work well, but it'll be a little bit of back and forth. With regards to the application process, the screen is accurate, the slide's accurate. Most lenders have been prioritizing existing clients to take care of them first. Obviously, prospective clients will get some consideration as well, provided they haven't gone through the process with their existing lender. The application process is actually quite easy. The form is a simple 2-pager. You do have to provide backup material, payroll support, etc., but it is not that difficult. So again, our government did a great job in simplifying an application process to expedite getting money out the door. Chuck, that's about all that I have on that slide.
Great. Thank you very much, John. That's very helpful. I know there's more information coming out on these as these things are changing fairly quickly. And so we'll continue to kind of keep you updated on that. So what we see business owners asking, these are some of the main things, and I'll pose these to John. What is the economic downturn impacting banks' lending parameters? So John, you want to see, for those who have a commercial loan out or looking to get a new loan, is much changing right now?
There's a lot changing right now. Banks obviously are still open for business. They are still making loans. The scrutiny and diligence will get ramped up, obviously, and a lot of attention will be paid to the ability of the business to continue to operate and survive in a new environment, which that's a difficult thing to do because it hasn't been defined yet. But banks will be looking to have discussions with borrowers about what steps they have done to combat the effect of COVID-19 and what opportunities are available for their business down the road. And I'd like to focus on opportunities. Things will be different, but this country is very resilient. Our entrepreneurs are very resilient. They just have to seek out what those next opportunities will be.
Great, thank you. And what's the downside of participating in the Paycheck Protection Program?
There's absolutely zero downside of participating in this program. It's a forgivable loan. Potentially, if you do things right, the whole thing can get forgiven. I can't imagine why any entrepreneur would not participate or submit an application in this program. This program is strictly about protecting paychecks to employees across the board. There's no downside.
So, worst case scenario, my understanding is you don't get the forgiveness. You have a loan, and I believe that interest rate is at 1%, if I'm not mistaken.
That's correct.
So that, I guess that'd be your worst case. You end up with a loan that you borrowed, but at a very low interest rate. Is that accurate?
That is accurate. I will add, I'm not too excited about carrying an interest or a 1% interest loan on the books for 18 months, right. But that's the rules of the program, so we'll go with that.
Okay, thanks. And we talked a little bit about this already, but who, what, when, and where do I get these loans? And it sounds like you were saying primarily you're getting it from your commercial bank. It's not something you shop. There's no reason to shop around to different banks for this loan, really, right? I mean, you probably, that's where you start.
100% accurate. Yes, you should. The beginning point starts with your commercial banking relationship. They will be able to get you into the system and process. The government specifically set this program up to funnel through the banks. And if you think about it, the reason they did that is they ran the risk of entrepreneurs laying off millions of workers, and then the unemployment claims, that system gets flooded. And so what they did was they came up with this program and participated with the banks to help roll out this PPP program, and it's a really good thing. So, they knew the government knew they were going to have to pay for this somehow, and you can either do it with the PPP program or run the risk of having the unemployment portal flooded, which, as we know, is flooded right now, but it would even be worse without this program.
Great, thanks. So the next one is how I should communicate with my commercial bank, and this is something I've had clients asking, sometimes a little bit nervous about talking to their commercial banker with revenues down and so on. Any quick tips on that?
Yeah, the communication should be like any relationship you have with trusted advisors, whether they be your banker, your attorney, your CPA, your financial investment advisor. The banks don't react well when they get surprised. So, good news and can usually wait to be told, but any news that is neutral or trending negative should be communicated quickly. And then the other thing that I'll say is the more organized your information flow is, the better. In other words, for example, using this PPP program, there's an application and a checklist. You should fill out the application properly and thoroughly. You should make sure that the items on the checklist are all submitted, and if something's missing, it should be identified as such. It just slows up the process if the communication is not organized and accurate.
Great. Thanks, John. And then the last one, I'll touch just what other potential corporate benefits are now available. And there's several others I talked about at our last webinar, some of the benefits for participants in corporate retirement plans. There's some benefits for defined benefit plans as well as funding. So there are some other ones. And then Jason Brooks will be talking in a couple of minutes on some of the tax credits that are available for business owners specifically. We'll talk later on in our discussion here. So some of the challenges facing companies, they want to preserve the health and well-being of employees while decreasing overhead. Take advantage of what opportunities they have to build some long-term profitability, maintaining financial flexibility. I hear that all the time, and to weather the storm in anticipation that eventually, our world's going to return to some normalcy. So on corporate cash flow strategies, some broad options. I'm sure many of you have considered just decreasing short-term expenses. So the last discussion we had, we talked about, companies have asked about, can they remove or amend corporate retirement plan contributions? And there's an interesting study that just came out from Fidelity a couple days ago through their listing of plan sponsors. And so to this point, what have companies done? And it was about 30% have made some change to their corporate retirement plan. In terms of the employer contribution, 70% have stayed put to this point. So we've seen some, but not a mass change for most companies. Obviously, payroll reductions, pay cuts, furloughs, termination, freezing discretionary spending, delaying major purchases on investments. Others is increasing corporate debt through commercial lending, other backup debt sources, using government programs that we talked about, and then maintaining corporate cash. John and I had a good conversation about this early this week. Obviously cash is always king now more than ever. So extending terms on accounts payables with suppliers if need be, improving your liquidity, and then extending the runway. That idea of make sure extending your runway given the kind of the uncertainty that we're in to get us through this program, our environment that we're in. So on tax considerations and opportunities, so this I'll turn it over to Jason Brooks, as I mentioned, CFP and CPA at Finspire, and to explain some of the additional tax benefits and strategies available for business owners as a result of the stimulus packages. Jason?
Thanks, Chuck. First, I wanted to cover the changes to the net operating loss rules. Net operating loss reduces the amount of tax a company paid on earnings either in the past or has to pay going forward in the future. Now, prior to the CARES Act, net operating losses could only be carried forward to offset up to 80% of taxable income for a given future year. Now, businesses and individuals can carry back 100% of their net operating losses from the 2018, 2019, and 2020 tax years for up to 5 years to get a refund against taxes already paid in past years. So, for instance, a C Corp could carry back a loss to a tax year before 2018 when tax rates were higher than they are today. Prior to 2018, the maximum rate was 35%. and now it's 21%. So they could get a bigger tax refund than by carrying it back than they would have if they carried the loss forward. Also, prior to the passage of the CARES Act, owners of pass-through entities were limited to the amount of business losses they could deduct in a given year against other personal income. Now those limits have been suspended. So taxpayers with excess business losses may be eligible for refunds on previous year's tax filings. So if you have losses from 2018 or 2019, it's best to discuss with your CPA now about your options for refunds. If you anticipate a loss for 2020, I would suggest you talk with your CPA later in this year to plan accordingly, as these things are a little complicated. Moving on to the next topic, there's another change, and that is the increased ability to deduct business interest expense. Currently, deductible business interest is limited to 30% of adjusted taxable income. Now, as a result of the CARES Act, 2019 and 2020 deductible interest is limited to 50% of adjusted taxable income. And one thing to keep in mind, partnerships are limited to only the 2020 tax year for the higher limit for the interest deduction. Now, on the next slide, there have also been changes to the tax filing due dates. So the IRS automatically deferred the April 15th due date for both filing returns and payment of any 2019 taxes due to July 15th. So essentially 4/15 is now 7/15. And no extension has to be submitted if you file your taxes by 7/15. The IRS has also deferred the due date of first quarter 2020 estimated tax payments from 4/15 to June 15. And they also deferred the due date for the second quarter 2020 estimated tax payments from 6/15 to July 15. So you get a little extra time to make any tax payments there. But the third and fourth quarter estimates due dates are the same as always, which is 9/15 and January 15. The IRS has also deferred the due date for 2019 IRA and HSA contributions to July 15th as well. Most states are offering similar 2019 income return filing and tax payment deadlines, moving those to 7/15 as well. However, some of the states are more varied on their due dates for the 2020 estimated tax payments. For instance, Illinois' 2020 quarterly estimated tax payments are not impacted by the CARES Act, and therefore those payments are due on the regular due dates. So if you were an estimated quarterly taxpayer and you forgot to mail your Illinois tax payment yesterday, probably want to get on that today. Moving on to the next slide. There's been some changes to charitable contributions with a new permanent deduction paired with the standard deduction, and then a temporary increase in the percentage of AGI eligible for cash contributions. So for tax filers who normally take the standard deduction on their federal tax filing return, they're not allowed to take charitable deductions because in order to do that, you need to itemize. Well, now, according to the new law, you can take up to a $300 cash deduction or $600 deduction if you're a joint taxpayer made to a public charity against your adjusted gross income, even if you do take a standard deduction. So it's a little extra benefit there. And then temporarily, the increase in deductibility of cash contributions to public charities is up to 100% of AGI. Previously, that limit had been up to 60% of AGI. Keep in mind, though, that the 30% limit for donated, 30% AGI limit for donated securities would still apply. Then just some ideas or tax strategies here. If you're looking at your investment accounts and they're down and it's a taxable investment account, one thing that I've been doing for clients is recognizing some losses. And we call that tax loss harvesting. So essentially what we're doing is we're selling securities at a loss, booking the loss, and then taking that money and buying something else, a similar stock or similar mutual fund. If you do this, you just have to be cognizant of the 30-day wash sale rule, which just means if you sell something and you want to buy it back, you have to wait 30 days or else the loss would be disallowed. The other tax strategy to consider would be maybe taking some traditional IRA money and moving it to a Roth IRA. By converting that going forward, then you wouldn't have to pay any tax on the Roth. This is a great strategy if you have an off year for taxable income. So if 2020, your business is suffering or your income is down due to COVID and you're in a lower tax bracket than normal, then maybe it makes sense to take some money out of your IRA, convert it to a Roth, pay the taxes at a lower bracket, and then again, get tax-free growth going forward. So now I'm going to turn things back over to Chuck, who will talk about action plans for business owners.
Great, thanks, Jason. So we'll be wrapping up some action plans. One is just prioritizing the health of employees and the clients. And so that's been number one for a lot of companies. And I give business owners a lot of credit. It's been a challenge to do this. And talk to business owners, they keep coming back to me time and time again. This is the main thing. And then maximizing available resources, what we talked about today through programs. Make sure you're filing your applications quickly, as John Spory talked about, and accurately, and keep abreast because we're not done. Again, there are going to be more changes. Stabilize your finance and limit your risk going forward. Good time to do that. And then positioning for a staged economic recovery. The anticipation that it's going to come back. It's hard to tell when that's going to be. It might be sooner than others. I've read some kind of interesting stats and talking to some individual companies about what's happened in previous recessions. And a lot of our clients said that's really where they grew or really changed their company. In fact, for the last 100 years, the U.S. economy has been in periods of contraction, roughly 1/3 of the time. And if you look at the Fortune 500 companies that are available on the market today, almost over 60% of them now started during a bear market. So you see companies like GE, IBM, GM, Disney, Microsoft, Apple, all started during recession. During the last recession, companies like Groupon, Uber, Smashburger, those all started. And historically, recessions have given forward-looking companies excellent opportunities to build long-term success. The challenge is triaging, what's needed today while still focusing and perhaps even re-engineering towards long-term plans. So also, some of the resources is your professional guidance. So it's a time to use that. So companies like us, Finspire, we've got these great resources behind us, as well as the commercial bankers, HR compensation consulting firms, tax and legal. So it's a great time to be reaching out to your tax experts, CPAs, your legal. They're getting a lot of questions also. So they've got great insight. Utilize them. They're a terrific resource in this type of environment. In finance and operations. So utilize those resources that are available to you and seek out ones that you don't have. So in closing, here's our contact information for us at Finspire, for John Spory at American Commercial Bank and Trust. We hope you found our discussion today to be insightful and impactful. Please feel free to follow up with any of us with any additional questions if we can be of assistance to your company or you individually. I'd like to thank my fellow panelists, Abram Claude of Columbia Threadneedle, John Spory of American Commercial Bank and Trust, and Jason Brooks of Finspire for their time and generosity and insight. As I mentioned, this is our second in a series of webinars, so look for future invitations and don't hesitate to reach out to us if there's something you'd like us to cover at one of these future discussions. So I want to ask James to put up a final poll question for the group. And while he's doing that, we're answer some of the questions that we have that have been asked. And so somebody like John and Abram and Jason, if you would just unmute, because some of these questions might be better off for you than me. Let me tell you, the first one here is really great for John Spory. What are the parameters of when businesses have to spend the payroll to be eligible to get the forgiveness? We've been shut down and are still partially shut down until the stay-at-home order is listed. When do you have to spend the payroll 75% of the money to be eligible? John, do you want to talk about that regarding forgiveness, when you have, what the time frame is for that?
Yes, and it's a little bit fluid to that question. My understanding is the clock starts ticking as soon as you sign the promissory note and the funds are dispersed into your account. So what do I mean by that? There can be a little bit of strategy if you as a business can survive for a little while without tapping into that money. It could make some sense to delay taking the funds immediately. Most clients, I believe, are taking the funds right away because they want to keep payroll in place right now, and they are still operating in their business maybe at a reduced level, some at full capacity, but maybe at a reduced level, and so this money is needed right away, right now. So again, I'll just keep saying it's a fluid process. There's really no right or wrong.
Great. Okay. Thank you. And then a second one along those lines, John, if you have a PPP loan and are using it primarily for payroll, are there any stipulations that you need to keep the company operating? That is, can production or the company shut down, but employees still receive their full pay during this time, paid by the PPP loan?
Yes, my understanding is that that is acceptable. If the business is shut down, the whole point of this program is to keep employees on the payroll. And so whether the business is operating at full capacity or temporarily shut down, the program is about keeping employees getting a paycheck. So.
Okay. Great. Very good. So that we had another question more on the student loan. It's a little more detailed. I have a follow-up question, so we might answer that one directly with so we answered that one and asked that question. And we will close the poll. The poll questions again: would you like to receive information on Paycheck Protection Program, company retirement plan strategies, personal financial planning guidance, commercial banking resources, or other? So if you answer that, we'll follow up with information for you on that. So in closing, on behalf of all of us, thank you for attending our webinar today. We hope you found this helpful and insightful. We wish you and yours good health and prosperity, and look for future invites for future webinars. Have a good afternoon, everybody.